Money Monday is sponsored by Huskey Financial.
Down markets can cause a lot of jitters among investors. People worry that their portfolios will implode as inflation skyrockets and stocks take a dive. Well, here to share his wisdom on this Money Monday is our sponsor, Stephen Huskey, certified exit planner and founder of Huskey Financial Group. Great to have you back.
Pleasure is all mine, thanks.
Crazy times we're living in right now.
Very much so.
So what would be your advice for people who are seeing inflation is just growing by leaps and bounds? It seems every day we're at a 40-year high at this point, and they're really worried about their stocks, about their investments. What's your advice?
It depends on which side of the mountain that you're sitting on. Either you're in accumulation right now and you're growing and saving like you and I are, or you're retired and you're worried about all the fixed costs that are continuing to increase. So if you're on a fixed income like you are, if you're retired, it's very important to know that you've got some guardrails on your portfolio, that you don't have to be as aggressive to make up for all the inflation that's eating away at your income. So guardrails could be anything conservative, anything that gives you guaranteed income every single year. That's not going to be as impacted as much by the inflation as stocks and other pieces of income.
What would a guardrail be? What would be a couple of examples of
I like to think of it as like if you're playing football and you have a really good offensive line, your quarterback has more time to work. So the individual investor would be the quarterback, and if you have some guardrails such as like an annuity, right? Like a fixed annuity can provide you with guaranteed income, and that should be a small portion of your portfolio, maybe 25 to 35%. What you're doing is you're exchanging that particular portion of money and giving it to an insurance company, and they're giving you a guaranteed set of income for the rest of your life.
Oh, interesting.
And it could also add a spouse to that as well.
Oh, okay. And what if you're on the other side of that mountain?
So like you or I right now? Just don't be emotional with your money. There's a study by Dalbar, I mentioned this in a previous session with you and that Dalbar studied individual equity investors for the past 30 years in comparison with the S&P rate of return over that time period. And they found that up to 2% worse is how the equities investors fared because they were emotional with their decisions. Let's say the S&P did 10%, the average equity investor got 8%. And so it's because of times like today when they're locking in losses, they're buying a stock when it's high, and so they're not sticking to their true investment principles, which they should follow and reduce the emotionality of what they're doing. Yeah,
I was just reading an article, Warren Buffett saying now in these times, don't do a whole lot. Just try to ride it out. I mean, we've been down this road many times before in our history. So we think we've learned. Is it any different than it's been in the past, would you say, just in study of finance and just the rockiness that Wall Street and the markets can provide?
Well, the history does repeat itself, as we know, whether it's fashion trends or it's the way the market reacts to different things. But in the past 40 years, we haven't seen inflation like this. As of June, it's 9.1%. And at the same time, the S&P 500 is down 20%. Typically, those two don't go hand in hand. And so people usually refer back to more conservative investments like bonds. But those have been behaving erratically as well. So people are looking for alternatives to create more fixed income in their portfolios, those guardrails that we talked about, which protect their equity position.
For any new investors at this time, what would your advice be? Because there's a lot of people who are eager to start entering into investments and really kind of tracking the market. Is now a good time to start that portfolio, or would you recommend people wait and see things kind of level off?
So I'm different than some advisors in the fact that I want people to have more liquidity on their balance sheet before they really start putting a lot of money away into investments. It's a little less liquid at that point. But what they should do is think about it like a pro golfer, like Tiger Woods, DJ, Cam Smith, who just won the British Open. Those are fantastic golfers. They're pros at what they do, but they have coaches. They have swing coaches that help them stay true to their form and see blind spots that they otherwise wouldn't have seen. Advisors like ourselves can provide feedback and help with the equity investing that a lot of individual equity investors might not be able to see.
That's where you come in. You're the coach.
We help with that stuff, exactly.
Yeah. Well, and I think the other thing that's helping Cameron is the fact that he has a mullet and a mustache.
I think the mullet might be coming back.
I think it is. When are you going to grow yours out?
Never.
I want to thank you so much for joining us. So for people who want more information, how do they find you?
www.huskeyfinancial.com, and you can email me at steven.huskey@cplanning.com.
Okay, great. It's great to see you.
Thanks so much.
We're back after this.
Money Monday is sponsored by Huskey Financial.